We continue with a deep dive into the global financial landscape with one of the most renowned and trusted voices in predicting global financial outlook. Please welcome Mr. Nouriel Roubini, the Professor of Economics and International Business at NYU Stern School of Business.
Ladies and gentlemen, distinguished guests, it's a great pleasure and honor being here. Thank you very much to the Family Office for inviting me to this amazing event in this amazing location. We're here in this beautiful island that is an oasis of nature, peace, and stability, but in a broader world that we know is characterized by a lot of uncertainty. I call it unusual, unexpected, unprecedented uncertainty, 4 U's rather than 1. And I'm here trying to understand what's going to happen to the world in the next few years. And we live in a world in which, whether you call it risk, uncertainty, or instability, there's a lot of stuff that is moving. And last year, of course, the election of Donald Trump, re-election of Donald Trump to U.S. presidency, increased the kind of uncertainties that we face in the world economy. Not just economic, monetary, financial, and trade uncertainties, but also political and geopolitical uncertainties. Now, to think about what's going to happen this year and the future, maybe worth just going back for a moment to what happened last year. Because as you recollect, on April 2nd of last year, when Donald Trump announced his Liberation Day tariffs, the consensus, the conventional wisdom about the US changed radically in ways that are very different from what were the views about the US and the world economy before. If you recollect, suddenly everybody became more pessimistic about the US and global economy and saying those tariffs will lead to a US and global recession and will lead to a sharp increase in inflation in the United States. Secondly, people argued that the policies of Trump would lead to the US shooting itself in the foot and the end of what people refer to as decades of American exceptionalism. 3, people argued that the US stock market was in a bubble and that bubble would burst, in part because of the stagflationary policies of Trump that would lead to lower growth and higher inflation. 4, since the US is running large twin fiscal and current account deficit that lead to a buildup of public debt and external debt, people argued that that's leading over time to an unsustainable debt position, both for public debt and external debt. 5th, people argued that because the policies of the new Trump administration leading to the end of American exceptionalism, that will lead to the erosion of the US dollar as the global reserve currency. So the exorbitant privilege of the US dollar would fade away. And 6th and final, as a corollary of the previous argument, that the US dollar would start to fall sharply and in a continuous way. Now, usually I tend to be quite the skeptic about the world. I'm concerned about the downside risk. But starting in April, I became more optimistic both about the US and the global economic outlook. And I argue that actually these 6 elements of the new consensus were incorrect. They would not have, for example, a US and a global recession. Now, the reason why I thought that things will turn out to be different, a slowdown in US and global economic growth, but not a recession, some modest but not severe increase in inflation, was driven by 2 considerations. Consideration number 1 was that market discipline would constrain the behavior of Trump. I've seen it happening in emerging markets. I've seen it happen in advanced economies. When policies go in the wrong direction, markets discipline, both vigilantes, but also stock markets and FX market punish you, and they lead you to a course correction. And guess what? 2 weeks into April 2nd, the S&P 500 was down 15%. NASDAQ was down 20%. 10-year Treasury bond yield went up 80 basis points. High-yield spreads went up by 150 basis points. And when Trump started to attack also the Fed in April, the dollar started to go sharply down. That's the point when one of his wisest economic advisors, Scott Bessent, went to Mar-a-Lago and told the president, I told you so before April 2nd. If you do these policies, eventually there'll be a shock to the market, there may be a recession, and you're going to lose the midterm election, and your MAGA plan is going to be dead on arrival. So, Mr. President, what do you want to do? Do you want to double down, or you want to blink and try to negotiate better trade deals? And the US president, who might be impulsive, but is not irrational, decided to blink. Some people say chicken out, tackle. Trump always chicken out. And guess what? He gave the job to Bessent to go negotiate trade deals. The tariffs that were announced on April 2nd were increasing the average US tariff from 3% to 30%, but those trade negotiations have led now to tariffs that are only of 14% on average. Now, is 14% bad? Yes. Is it terrible enough that's going to lead to a US and a global recession? Of course not. Movements of currency can be more than 10% per year, and they don't lead to a US and global recession. And guess what? Because one, he decided to blink and negotiate better trade deals, we have had a slowdown in US and economic growth globally, with some pickup in inflation in the United States, with something people refer to as a growth recession, growth below trend for a few quarters, but we have not had a US and a global recession. Now, if you think about the United States, actually, not only we have not had a recession, but the third quarter GDP number for the third quarter were much higher than potential, 4.3%. If you look at the nowcast by the Atlanta Fed of what growth is going to be in the fourth quarter of this year, we don't have yet the official number, they said it's going to be as high as 5.4%. So even that slowdown of the US has not occurred. Why? In part because there is many tailwinds in the US economy, but the key one is the boom that has come from AI and the investment done by Mach 7 and hyperscalers in the technology of the future, something to which I'm going to go back. Now, if I think about 2026, therefore, the world looks better than 2025. In 2025, US economic growth looks like it's going to be above potential. China is going to have a growth rate last year close to their target of 5%. Europe and Eurozone had a slowdown of growth, but they avoided a recession. And as my good friend Amer Bizat pointed out in the previous session, emerging markets overall are doing well. They're doing well, one, because there is some good luck, and with US and China growing, emerging markets are going to do fine, but also their economic policy, macro and structural, have become better over time. Now, if I look at 2026, I think that if we beat the bullet in 2025, this year is going to be better. US economic growth actually is going to accelerate, and inflation in the US is going to fall closer to the target of 2%. Why do I think the US growth this year is going to become stronger? One, we've had already monetary easing by the Fed, 75 basis points last year. There'll be a little bit more, not much more this year. Secondly, there is still a significant amount of fiscal stimulus in the pipeline. All the spending cuts are going to occur after the midterm election rather than before the midterm election. Business confidence is still very high, and capital spending by the private sector is still strong, especially, of course, in technology and AI, but not only there. Four, financial conditions are very easy. You have short rates that have fallen. Bond yields are low, around 4.2%. Equity markets are at all-time high. Credit spreads for high yield and high grade are still very compressed. And the weakening of the dollar has been moderate and therefore not inflationary and is leading to some increase in US competitiveness. So actually, I think that this year, US economic growth could be closer to 3% when the official number about potential growth is only 1.8. And inflation is going to fall, one, because the base effects of the tariff are going to be phasing out. Two, because there is now a slowdown in wage growth and productivity is increasing, and therefore unit labor costs are falling. And other elements of service inflation, like rents, are slowing down as well. So US economic growth is going to remain strong. Inflation is going to be lower. China has also done well last year, and this year is going to be okay. I think there is weakness of domestic demand in China, we know it, but consumption for structural reasons and investment because of a number of uncertainties. But net exports of China have done well. Chinese exports to the US have fallen, but Chinese exports to the rest of the world have increased. And while the currency of China remained close to the US dollar, the weakness of the dollar has implied a trade-weighted depreciation of the RMB relative to the rest of the world, increasing the competitiveness of China. So maybe this year China is not going to achieve a growth of 5%. It's going to be closer to 4.5%. Even Europe and the Eurozone that last year was weak is going to do better because you have fiscal stimulus and more spending on defense, not just by Germany, but the rest of Europe and the Eurozone. And if US, Europe, and China are doing well this year, emerging markets that have better macroeconomic policy and better overall reform and governance are going to also do overall well. So this year is going to be actually better than last year, and last year we avoided a US and global recession. Now, one of the main reasons why I was optimistic last year was not only because I believe that market discipline works, but because I believe that actually technological innovation is going to transform the world in ways like we've never seen literally in history of humanity. While everybody is obsessed today about AI and Gen AI, this is only one of the dozen of technology of the future going to increase to a secular economic boom. First in the country they innovate, like US and China, but also those that adopt these technologies that could occur across the world. So we have AI, machine learning, and Gen AI. We have semiconductors. We have robotic, automation, and emergence in the next few years of humanoid robots who can do a lot of manual work and cognitive work. We have biomedical research. It's going to make us live healthier and longer. We have quantum computing. We have green tech, and of course, the transition to a less carbon-based global economy. We have new forms of energy, like fusion energy, that's going to become commercially viable in the next 5 years or so. We have the mobility revolution, today EVs and semi-autonomous vehicles, but eventually fully autonomous vehicles. We have agtech, we have fintech, we have space exploration and exploitation and commercialization. We have new material science, and we have new forms of cryptography. So while everybody's obsessed about AI, this is only one of the dozens of the industries of the future. Each one of them is in a rapid exponential growth. All of them are enabled, of course, by AI, but all of them are leading to an increase in potential growth. First in the countries that innovate, and then those in the countries that are going to be also adopting these technologies. So it's not just the innovators that benefit, because these are general purpose technology, and those who adopt them can also benefit. So for example, in a region like this one, where there is very cheap energy, it makes sense to have data centers that use a lot of energy here, as opposed to the United States, where energy costs are higher, and therefore the benefits coming from data center and AI can also spread to adopters of these new technology and data center in the kingdom and in other parts of the Gulf. The reason why, therefore, I became optimistic, and I said on April 2nd, I said the following thing that became a meme. I said, tech trumps tariffs. And what do I mean by tech trumps tariffs? The implication of technological innovation on potential growth are first order, and the implication of other policies that are stagflationary, things like tariff, protectionism, restriction to migration, having large budget deficits, fiddling with the independence of the Fed, and so on, in my view, are second order. I do believe that actually, because of this innovation, US potential growth by the end of this decade is going to be as high as 4%. Today, the Fed and the CBO estimate the US potential growth is only 1.8%. So the upside coming from technology is 200 basis points, going from about 2% growth to 4% growth, while all these stagflationary policies, moderated by market discipline, imply a downside to potential growth of only 50 basis points. So you have an upside of 200, a downside of 50. The ratio between the two is 4-to-1, tech trumps tariffs. That's the argument I made, and that turned out to be correct. Now, in this race to the technology of the future, US and China are certainly number one. We can have a debate on whether US ahead of China or China ahead of US, but those are the innovators, but there is lots of other pockets of innovation. There is innovation occurring in Asia, in India, in Taiwan, in South Korea. There's innovation also occurring with adoption of these technologies in the Gulf. Israel is a startup nation. Parts of Europe are also innovating. So everybody's going to innovate. Those that are innovating more are going to have a higher potential growth, but the spread of this general purpose technology is going to lead to stronger economic growth across the world. So tech trumps tariff. Now, that leads me to the second point. I don't believe that American exceptionalism is over, Because think of it this way. For the last 20 years, when US potential growth was only 2%, the US stock market, S&P was returning you about 12% per year, including dividends, and the NASDAQ was returning you 16% per year, including dividends. Suppose the US potential growth goes from 2 to 2.5 to 3, 3.5, and 4. Maybe I'm too optimistic, and it's not going to be 4. Let's assume it's only 3%. Going from 2 to 3% is 50% increase in potential growth. So if you had American exceptionalism with the economy doing well and the stock market doing well when potential growth was only 2%, when potential growth is going to be 3%, American exceptionalism is not going to be over because tech trumps tariff. The first order effects coming from technology dominate any of the more stagflationary policy that maybe that are pursued in part by this administration. That leads me to the third point. People argue that the US stock market is in a bubble and this bubble is going to burst. But as I pointed out, if US potential growth is going from 2 to 3%, let alone 3.5 or 4, returns on the stock market are going to be higher than in a world where growth was only 2%. Doesn't mean that everybody's going to win. There'll be winners and losers among publicly traded company, and there'll be winners and losers among the startups in the technology of the future. That's what creative destruction is. But overall, arguing that the US stock market as a bubble is going to crash is not true if American exception is going to remain and growth is going to be higher, and therefore the average return to US and also other countries' equities are going to do well because of the adoption and innovation of these technologies. Fourth point, about whether the US twin fiscal and current account deficits are sustainable or not. Of course, people worry about US budget deficit of 6.5% of GDP and a public debt is rising. But when the Congressional Budget Office estimates that US public debt as a share of GDP is exploding, they're also assuming that US potential growth is only 1.8% for the next 20 years. If you make even just a simple scenario analysis, as the CBO does, that US potential growth goes from 1.8 to 2.3, only 50 basis points higher, public debt rises for 15 years and then stabilizes as share of GDP. If you assume that growth is going to be closer to 3%, the public debt as a share of GDP starts to fall and falls even more if growth is going to be about 3%. So I don't want to be blasé about the US fiscal deficit, but my point is that the best solution to a debt and deficit problem is growth, because debt is debt to GDP. And if the denominator is growing faster, something becomes more sustainable over time. And the reason why 10-year Treasury yields today are still only 4.2%, quite low by historical standards, might have to do with the fact that people are realizing that US potential growth is much higher. As I pointed out, in the third quarter of this year, US growth was 4.4%, and the first estimate for the fourth quarter is about 5%. I'm not saying they were already at 5% potential growth, but certainly potential growth in the United States is not anymore 1.8%. It's rising because of the rapid adoption by a number of firms of these technologies of the future. That leads me to the fifth point. People worry about the exorbitant privilege of the US dollar and the fact that the US has weaponized the dollar for national security and foreign policy purposes has led to concerns that people want to dump the US dollar as a major global reserve currency. And that's going to lead then to a disorderly collapse of the US dollar. I'm skeptical of this for a number of reasons. Reason number one is that you cannot replace something with nothing. And if you don't like the dollar, what's the alternative? And as a former US Secretary of the Treasury said, rightly so, he said, people don't like the dollar, but what's the alternative? And he said, Europe is a museum, China is a prison, Japan is a nursing home, and Bitcoin is an experiment. So you might not like the dollar, but what's the alternative? Point number two, in spite of tariffs, the US current account deficit is not going to shrink over time. It's going to become bigger. Why? From a macro point of view, the current account as a share of GDP is national savings minus national investment. US private and public investment are stable, not going to go higher or lower, but there is an investment boom because of the capex coming from AI and technology of the future. So US looks like an emerging market where you found a natural resource, you have an investment boom, your current account deficit becomes larger, and eventually you're going to pay back your debt by exporting more. Same thing in the US. We're in the middle of an investment boom. In spite of the tariff, the US current account deficit is going to become smaller, it's going to become bigger, but it's going to be financed by what? Capital inflows in the equity market. FDI, brownfield and greenfield, VC money, portfolio investment, and that is going to finance the investment boom in the technology of the future. That leads me to my final point. People say the US dollar is going to be in a disorderly fall, and guess what? Last year it fell, and this year is also starting to fall a little bit more. But think of it from a medium-term perspective, and ask yourself, say, compare US to the euro. This past year, the euro has appreciated by 15, 20%. But US potential growth by the end of this decade is going to be 4%, while a Eurozone that is not essentially reforming and innovating is going to be stuck at a potential growth closer to 1%. And over the medium term, exchange rate depend on real growth differential and productivity differential. So if the US is going to grow 4% by 2030, a Eurozone is at 1%, the value of the euro has to fall, because if you're not growing through domestic demand and innovation, you have to grow through exports. And to have more export, you need a weaker currency. So my bet will be that actually the euro is going to be well below parity 5 years from now, as opposed to being stronger in the short term. So final point is I make, we're going to have a good year for US and global growth. American exceptionalism is not over. The US stock market is not in a bubble. The debt of the US is more sustainable with higher growth. And the exorbitant privilege of the US dollar in a world, the US remains the major global currency, the major economy in the world, the most innovating country. That exorbitant privilege of the dollar is going to continue, and the weakness of the dollar is going to be only short-term rather than medium and long-term. Thank you for your attention. And if there is time, I'm happy to take a couple of questions, but I don't know if we have time or not.
What are your views about crypto, if I may?
Well, you know, I've been skeptical about crypto, and think of it this way. Last year, Trump was elected, and it was the most pro-crypto administration in US history. He passed the Genius Act, he made his own private investment in crypto, he gutted all regulation of crypto. And if you ask people at the beginning of last year, the people in the industry said Bitcoin is going to be at the end of 2025 200,000, 300,000, 400,000, 500,000. What happened to Bitcoin last year? It fell in value by 8%. It fell 30% from its peak in October. And then the meme coin of Trump has lost 95% of its value. The entire industry is right now is back again in the winter. People said the Bitcoin is going to be the new digital gold because there is deficits, because there is debasement of fiat currency, because there are geopolitical risks. But guess what? Last year, real gold went up 60%, silver went up by 160%, and Bitcoin went down. Whenever there is a risk of episode and the stock market goes down, Bitcoin goes down even more. So it's not a hedge against tail risk. While when there is a tail risk, geopolitical, financial, trade, or otherwise, gold goes higher, and crypto and Bitcoin go lower. So they're not a hedge against tail risk, they're not a hedge against inflation. They're a very speculative asset. And by the way, people call them currency, but anybody who knows anything about money knows that they're not currency. It's not a unit of account. For something to be a currency, things have to be priced into that. So in Europe, things are priced in euro, in US in dollar, here in real. Nothing is priced in crypto. Secondly, it has to be a scalable means of payment. With Bitcoin, you can make 6 transactions per second. With the Visa network, you can make 60,000 transactions per second. 3, something has to be a stable store of value. You know, crypto and Bitcoin can go up one day 10% and fall 20% the next day. That's why even in crypto conferences, they want to be paid in dollar fiat, not in Bitcoin, because your entire profit margin can essentially be wiped out overnight by fall in crypto. And finally, something to be a currency has to be a single numerator. If I have to tell the relative price of bread to beef, I need to have a single thing as a numerator. But in a world in which you have thousands of ICOs and different tokens, and I need a Coca token to buy Coca-Cola and a Pepsi token to buy Pepsi-Cola, I cannot even have a single numerator. You have thousands of numerators. It's like going back to barter. I mean, even the Flintstones had a better monetary system because they're using shell as a single numerator. So calling them currency is just a misnomer. Anybody knows anything about theory of money knows they're not currency. And the country in the world that adopted crypto or Bitcoin as legal tender in El Salvador 3 years ago, less than 3% of all transactions occur using Bitcoin in a country where it's legal tender, meaning you can go to any merchant and say, I want to buy bread using Bitcoin. Nobody's using it. So it's a fad. Yes, sir.
If I may. So there is no doubt about the benefits and change that's going to be brought by AI. That is not questionable. But allow me, as a journalist, to be the cynic or the skeptic in the room. The hype that we are seeing about AI cannot but remind me of the dot-com bubble of the early 2000s. My question to you is this obsession with the commercialization and the overpromises of a technology that may still be at a very young stage. Do you fear an AI bubble similar to what we've seen with the dot-com bubble?
No, I don't believe that the comparison with the dot-com bubble is correct for many reasons. You know, during the dot-com bubble, you had thousands of firms had no real business plan, no revenue, no profits. You had, 20 pet.coms ideas and 19 out of 20 failed. This time around, if you look at the Max 7 or the hyperscalers, they're highly profitable, revenue growth is exploding, earnings are growing up, P ratios are high, but compared to the peak of the NASDAQ during the dot-com bubble, P ratios are actually reasonable for firms that are going to be growing like crazy, and therefore that comparison, in my view, is not significant. As I pointed out also, while everybody's obsessed about Gen AI, as I pointed out, there are 12 industries of the future. Each one of them, there is a productivity growth, and it's going to lead to exponential growth over time. 4% growth in US by the end of this decade, maybe 6% by the end of the next decade. And US and China are number 1 or number 2 in these technologies of the future. If you look at the revenue in real terms of S&P 500 firm, not just of the Max 7, since the launch of ChatGPT in November of 2022, so about 3 years ago, the average real revenue of all S&P 500 firm has gone up by 15% over those 3 years, about 5% per year. Of course, telecom services and tech has gone up more by 20%, but it's across the board. Everybody's adopting those technology, and gradually that leads to more profitability and more revenue growth. Is there frothiness in this market? Yes. Is everybody going to be a winner? No. Is each one of the Max 7 is going to be able to be successful? Probably not. But think of it this way. The race in the US is about AGI, artificial general intelligence. And the question is not whether, but only when AGI is going to occur. And if you ask people that are senior in the top AI of this world, they tell you we are at worst 6 years away from AGI and at best 3 years away from AGI. Now ask yourself, suppose you're a Max 7 and you reach AGI, and it's not the zero-sum game. 3 or 4 of them probably going to get to AGI. What's going to be worth a firm that achieves AGI? Today, those Max 7 are worth $3 to $4 trillion. Some people in the industry, and they told me, we believe that if firm reaches AGI, the market value of that firm is going to be $100 trillion. Now, they're talking their book. Suppose they're wrong by a factor of 2, it's 50 trillion. Suppose they're wrong by a factor of 4, it's $25 trillion. But think about 3 or 4 of the Max 7 or an OpenAI that are worth today 3-4 trillion, going from 4 trillion to 25, and maybe a couple of them don't do well. Maybe NVIDIA is disrupted by a new form of semiconductor architecture, and the value goes from 4 to 1. You still have a huge upside among even the publicly traded AI firms of the world. And US today is in a race towards AGI. And if you think about reaching those types of market value, spending for OpenAI another $1 trillion over the next 5 years to achieve AGI, and today, in spite of Gemini 3 being better, OpenAI's ChatGPT is still having 70% of the LLM market. Making that bet of $1 trillion is not such a bad idea. So think of it in this term. In the US, it's a race towards AGI, and once you reach AGI, this market value will be much higher than they are. So we are not in a bubble.
I'll ask the question in the meantime. I'm here.
Yes.
Thank you so much. My name is Faris Al-Ghannam, and thank you for your optimism after a slightly skeptical geopolitical morning. So it's refreshing to hear your talk especially about the big themes. But my question is the following. We also see big spend in weaponization and defense in the US and in Europe in particular, which is expected to increase. How is that going to play out with the several technologies you mentioned? Is it going to actually accelerate it? Is it going to slow it down? So your views, please.
Well, I think the two parts of your question are connected. There are geopolitical risk in the world, and because of geopolitical risk, everybody is going to spend more defense. US is going to spend more on defense. Europe is going to spend more on defense. Russia, Ukraine, here in the Middle East, of course, everybody in the Gulf has to spend more on defense because there are threats coming from Iran and others. Israel is spending more on defense. China will, Korea, Japan, you name it, Taiwan. So we live in a world in which defense spending is going to go higher because we have geopolitical risk. On the geopolitical risk, I'll make the following point. I'm all aware of them, but so far, the market and economic impact of them has been small. Yes, the Russia-Ukraine war is still continuing. It's 4 years now since it started. Initially, the shock on energy prices, food, and industrial metal in 2022, that shock has been faded out. Venezuela might be geopolitically important, but with less than 1 million barrels a day produced today, and now going to produce much more, much less. Geopolitically, maybe it's important, but from economic and market point of view, is not important. What has happened with Greenland, again, is not something that has significant impact. And while US and China are in a rivalry, there is a truce right now, because both sides realize that, of course, they can damage each other to tariff, and therefore the relationship, for the time being, has become more constructive. Even in this region, last year we had a major shock. There was a 12-day war between Israel and Iran, and US eventually had a brief attack also against the Iranian facility. There was a blip to oil prices, but people in the market correctly realized that Iran was either unwilling or unable either to block the Strait of Hormuz or to mine the Gulf, or unwilling or unable to try to damage the production facility or the pipelines of Saudi and the rest of the Gulf. That's what happened in that war. And therefore, the market essentially faded out that risk. Now, there is still a risk, and I would say among the geopolitical risk in the world, if, and I don't know whether it's a baseline or not, if there was another major war between US and Israel on one side and Iran, a regime that is now desperate could, at that point, say, at this point, I'm going to start attacking the Gulfies. It's a risk. I don't think it's my baseline, and I hope it doesn't occur. And I think that cooler, essentially, people in the Gulf are telling the United States, both the Saudis, Emiratis, and others, don't do it because there is a risk of something that's going to be damaging to the world economy. So that's a risk that we have to consider, but is one that hopefully is going to be constrained and limited. And this regime in Iran may collapse on its own because economically and otherwise is completely, essentially, on the ropes. Now, on defense spending, my view is as follows. The nature of defense spending is not just spending more, but spending in defense tech. Because the nature of warfare today is that the $10,000 or $5,000 drone can destroy a fighter jet that costs you $100 million or a tank that costs you $20 million. And the issue about defense tech is not just the drone. It's having the satellite that gets you the information, the intelligence, and the drone. So it's a whole vertical stack of defense tech that changes the nature of warfare. And which are the countries that actually are growing faster? The countries that are growing faster are those that are investing in defense and defense tech, because most defense innovations have dual use. They can be used for a military, but then there's a commercial use, right? In the US, for example, before we had nuclear power, we had, unfortunately, nuclear bombs. The jumbo jet started as a defense military cargo project. The internet was invented by DARPA. There was a military intelligence agency of the United States. So the countries that are innovating more on defense, US, China, in this region, for example, Israel and others, are those that actually are getting the dual use and are getting the benefits of those types of innovation. So people in Europe worry about spending more on defense and saying it's either bread or guns or butter and guns. Is a misnomer trade-off. One of the reasons why Europe doesn't have enough innovation is because for 80 years, they didn't have to spend anything on defense. And therefore, the dual use coming from defense spending and the benefits come from a commercialization has not occurred. So Paradoxically, geopolitical risks lead to more defense spending, but the nature of defense is changing, it's becoming defense tech, and defense tech is going to lead you to positive spillover in terms of commercialization of some of those technological innovation. Unfortunately, every time there's been a major conflict, there has been some defense or military innovation, but then those things have led to commercialization of that. So that world of geopolitical tension by leading to defense tech leads also to more innovation and more potential growth, as long as we avoid real wars and conflicts. Of course, if there are real conflicts, of course, it's a disaster for the world.
Now, assuming an optimistic outlook for 2026, and whatever happened to gold and silver in the past few months, do we still see it, or do you still see it personally as a hedge in investment, looking at an optimistic view, looking at China, what they're doing in terms of collecting gold? This is what we've been hearing in the morning as well. Or is it not anymore, assuming that the stock market will be rising?
So you're asking about gold or stock market or both?
About gold and silver. It has always been seen as a hedge, right? I mean, investors see it as a hedge. Do you still see it as a hedge with the increase in momentum?
Listen, we live in a world in which, first of all, there are geopolitical tensions, and gold has been always a good hedge against those tensions. So one day might be Venezuela, the next day might be Greenland, the third day might be the risk that now something may happen with Iran. So those tensions are not going to go away. In my view, they're not going to lead to major wars, but people want to hedge it. Secondly, there is large public and private debts. There is a risk of monetizing them in some countries that they are not able to finance them otherwise. There are public debts are very high in Europe, in Japan, in some emerging markets. So the basement trade has been one trade that's led to higher gold and silver prices last year. Three, we have also the risk that if the US is weaponizing the dollar for national security and foreign policy purposes, which is the only reserve asset, it's not a currency, that cannot be seized by the US or Europe. In the case of Russia, Ukraine, you remember the foreign assets of Russia, of the central bank, not just dollar, euro, yen, pound, Swiss francs were seized. So the only thing that cannot be seized is gold, and not financial gold, GLD, because that's subject to sanction, but physical gold that you keep in the basement of your own central bank, PBOC or Russian central bank. If it's financial gold, that can be also sanctioned as well. And those things are going to continue. Countries that are rival of the US are worried that the US is going to eventually freeze their own assets. And even those that are not rival of the US fear that if they don't follow the US sanctions, they will be subject to secondary sanction. So even some of the frenemies or friends and allies of the US, the Brazils of the world, the South Africa are saying, what happens if instead I'm the collateral damage of some tension between US and China? And therefore they want more gold. So overall, having an overweight in gold and precious metal is something sensible in a world where you have geopolitical risk, where there's too much debt, there is a risk of inflation and debasement of fiat currency. But I go for real gold, because as I pointed out, Bitcoin is not digital gold. It always goes down when there are these risks, as opposed to going higher. So if you want to be having a hedge, there are plenty of other hedges: financial assets, real assets, tech firms, energy is going to be a hedge, industrial metals, food, and lots of other things are going to be hedged against inflation, but certainly precious metals being liquid and being a reserve asset by central banks and private investors are also a good hedge against some of the tail risk we're going to face in the world.
What do you think of the nomination of the new Fed governor, and how do you see that policy, the current policies changing?
Well, it looks like, as I was reading the newspaper this morning, that the choice is going to be the one of Kevin Warsh. I would say that there is a better choice than the one of Kevin Hassett. Kevin Hassett was somebody that was very loyal to President Trump, while Kevin Warsh was somebody that, at least in the past, was on monetary policy. When he was a Fed, he was a hawk rather than being a dove. He's actually a globalist. He might not say that he loves the tariffs of Trump, but in reality is somebody that is a globalist, and he believes in global trade and globalization in an intelligent way. So he's going to talk maybe the talk of Trump, but on many substantial issues: financial stability, having independent central bank, having interest rates that are appropriate given the business cycle, having pro-globalization views, I think is going to be a constructive choice. Of course, it's going to be subject to pressure by the president, but in the system of the United States, the Fed chair is not an absolute monarch, is a constitutional monarch, is what Latin say, primus inter pares, first among equal. So the Fed chair has one vote, and he or she has to convince the rest of the board and the entire FOMC to go along. So even if they'd chosen somebody who was totally loyal to Trump, he would not have been able to essentially force the rest of the FOMC to go and cut rates at a time where US growth is actually going higher, inflation is still closer to 3 than 2, and therefore, if I was a Fed chair, I would say that even one cut this year probably is not warranted. The US is going to do well in growth, inflation is going to remain above target, even if not so much above target, and therefore, from a fundamental point of view, there's no reason to actually cut interest rates. If you cut interest rates, you may fed overheating of the economy and inflation. Now, we'll see what his policies are going to be, but certainly from a market point of view, is somebody that's coming from the private sector, was at the Fed before, used to be a monetary hawk, now pretends to be a monetary dove. I'm not sure if it's truly so. And there, from a market point of view, that's a much more constructive choice. And paradoxically, and that proves the power of market discipline, when Trump started to attack the Fed and Powell, and they started the investigation of Powell on the legal issue, it backfired because suddenly the market went down. The senators, even Republicans, said, we're not going to vote for any nominee until this matter is cleared. And then essentially the market told Trump, if you choose somebody dovish who's weak, we're going to punish you. So market discipline worked on April 2nd. It worked with the Fed independence. It worked on Greenland. It worked when he tried to bully China and the market went down. And the most powerful people in the world are the bond vigilantes. Trump controls his party, controls the Congress, controls the Supreme Court. He might even control social media. He cannot control the bond market vigilantes, the stock market, the credit, and the FX. Those are the ones that put constraint to his bad policy. That's what I said a year ago, and exactly what's happened. So I would say those who come to the rescue of the economy with their bad policy are the market investor and participant. Those are the ones that are constraining and disciplining bad policy from happening, and that's why it shows somebody that's actually reasonable and good for the markets.
Dr. Roubini, thank you for the very interesting outlook. And considering the discussion about growth looking forward, particularly in 2026, what in your mind is the major risk when taking into consideration the aggregate of all possible risks? Which one major risk do you see investors are currently underpricing or underestimating?
Well, you know, the things that can go wrong are several. In my view, they're not making a baseline. People worry that the labor market in the US has been soft, and there has not been much job creation. I have an optimistic interpretation of that. US GDP growth has been actually strong, while employment growth has been close to zero. And now some people say the GDP number will be corrected towards the labor number, or the labor number going to cause the economy going into a recession. My view is actually that since we have high growth and we don't have job creation, productivity growth is high. And it's high because firms, not just in the tech sector, are using the technology of the future to increase productivity and profits and their own revenues. But that's certainly a risk, together with the fact that this is what people call a K-shaped economies, where 20% of the people get most of the income, most of the wealth, they're driving consumption, while half of the people have no equity wealth, they live from paycheck to paycheck. So if the real shock to jobs and to employment were to occur, that could trigger a downturn of the economy. Again, it's not a baseline, but the combination of a soft labor market and a K-shaped economy is a downside risk. The second one is the risk that this AI is all a bubble. It's going to lead to a stock market crash, a collapse of capex. But in my view, as I try to argue, that's really an incorrect view. To satisfy the current demand for data, the pipeline of the data center that has to be built in the next 3 years is just sufficient to satisfy the current demand for compute. And once we're 3 years from now, closer to AGI, there'll be an explosion in the demand for a data center. So I don't think that's a bubble either in terms of the capex or in terms of the stock market, but that's one thing that people worry. Third thing people worry, as I said, is geopolitical risk. In my view, Venezuela is not important, Greenland is not important, Russia, Ukraine, even without a ceasefire, is not important. China and US are now having a truce on trade, and for the time being, the truce is going to remain. The big question mark, if whether something big could happen with Iran this year. That could be a shock to the economy and the market. Again, it's not my baseline, but I would say of all the risks that are geopolitical one, this is the one that maybe people have to worry about. Final risk, of course, people worry about these deficits, not just in US, but also in Japan, in Europe, in advanced economies, and some emerging markets. And we've already seen bond yields in Japan going higher, that pushing higher bond yields in the United States and Europe. Many of these European countries have weak governments, whether it's UK or France and others, and the deficit may become over time unsustainable. I think those kind of risks are there, but they're slow motion. They're not going to materialize with a spike in bond yields across the world significant this year. But of course, if debt and deficits in the weaker country were to increase over time, that's a risk. As I pointed out, I don't want to be blasé about the US, but with stronger economic growth, I think the US public debt is sustainable over time, even if the deficit and the debt in the short run look like high and rising over time. So those are the downside risks. To me, they don't make a baseline for having a significant economic slowdown this year globally, let alone a recession, but those are the kind of things you'll have to worry if you have to worry about downside risk, of course. Okay, thank you very much. Thank you.